Thank you for taking time out of your evening and giving the old man your ear. Here's really what has transpired. You know, if you look back when you bought a home, you went to the bank and you filled out some paperwork. And one of the pieces of paper that you signed was your mortgage. And it was notarized and it was recorded with the register of deeds, or clerk of county clerk of court, whatever. Okay? And the other piece of paper that you filled out and signed was a promise, and let's say you borrowed $400,000. Well, you signed a piece of paper where you promised to pay that man across the table or his representative $400,000 over a period of 30 years or 20 years or whatever the term was. But you signed that piece of paper and it was not notarized. But it was like signing a blank check. But it was a promise to pay, which made it a negotiable instrument. Now, when you signed that paper, you thought that the bank was going to give you $400,000. That's what you thought. Well, when you signed that piece of paper, what did they give you? They didn't give you anything yet. You just signed the document, and that piece of paper became an asset for that bank. It was now an asset that they owned. You no longer owned it. Yours was a promise to pay. So that asset was now $400,000 of theirs, and here's what they did with it. They didn't give you any money yet, but they took that asset and they created a bond, just like you would bail your nephew out of jail. They created a bond, and that bond they took it to the Federal Reserve, and the Federal Reserve gave them approximately 10 times the amount of your promise to pay. Now, let's say your promise to pay was $400,000. The Federal Reserve gave them a credit of about $4 million. Now, how much money have they put up? They have put up absolutely zero. They leveraged, and the technical word for it is monetized, but they leveraged your promise to pay to create $4 million. And they still had your promise to pay. They kept it. They just created a bond. They then took your promise to pay to another party, and we'll call that party a wholesaler. And that wholesaler took it to what we call an aggregator or trustee. And it was then sold to a trust. And 95% of the trusts are in New York. So it was sold on Wall Street. Well, where did the money come from for this note? Where did it come from? Well, the trust filed, before you even applied for that note, the trust filed what we call an 8K filing with the Securities and Exchange Commission, and we'll call it the Rosado Trust. And they told the Securities and Exchange Commission that they were going to sell investment certificates, and they were what we call mortgage-backed securities, or they were called CDOs, collateralized debt obligations. Whatever fancy term they called it, that note was the security for these folks to induce certificate holders or investors. Let's just say the folks that are listening to this phone call, let's say they represent the school teachers in their area. So the school teachers' pension plan invested $10 million each into this trust that was backed by your promise to pay. So they were given, let's say 6% return on their investment. but you were paying maybe 7%. So the trust was earning money, okay? Now, those certificates, okay, that were purchased by the investors, okay, that money went back to the bank that you signed that promise to pay with, and that's where the funds came from for you to buy your house. Wow. Wow. Listen to this for a minute. That piece of paper that was never notarized traveled all around the world, gathering a lot of money. It created $4 million for the bank in credit on your signature. It also induced a lot of school teachers' pension plans or firefighters' pension plans to invest into that trust. They got an investment certificate, and the funds came backwards to the bank, and the bank then, through the title company, they provided the $400,000 to purchase the house. Good deal. Very good deal. For who? For the bank. They got $4 million in credit and didn't put up a nickel. Now, the trustee for this trust, he is provided what we call a pooling and services agreement. That's his management book. That's his rules. That's what he has to follow to comply with the SEC rules. So in that pooling and services agreement, there's a clause in there that says if you fail to pay your mortgage, they entered into an insurance contract so that if that mortgage wasn't paid, the insurance company would pay it. But the money wouldn't go to you. It would go to the trust. And then we call that a credit default swap, and the insurance company is, listen to this, AIG. Now, when you got in trouble, and you lost your job or your overtime, or for whatever reason, you tried to contact the bank and you got the runaround. You ended up talking to this person, that person, submit these papers, oh, we lost them, submit them again, and all that crap that goes with it. But you were told we can't help you until you're 90 days late. Everybody's heard that. Well, guess what happened on day 91? On day 91, the insurance policy that the trustee entered into with AIG triggered a payoff, and the trust received the full amount of the note, regardless of how much you paid on your mortgage. They got the full amount of the note. So if the note was insured for $400,000, the trust got $400,000.